Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to this episode of the Physician Sense Podcast. I'm your co-host, Tyler Olson, my fellow co-host, who's always bright and cheery and full of sunshine. Chad Chubb is with me as well. And today we have a special guest, a well-respected and expert in disability insurance, particularly in the world of physicians, is with us, a person I've known for many years now. Michael Relvas has joined us, and we're going to be talking about some specific questions related to disability insurance and how it relates to all of you who are going to be in training, are in training, out of training. It's super important to protect your income, and so that's why we wanted to discuss some facets of this area of financial planning. How you doing, Chad?
Good. Ready to rock and roll? Got the expert with us.
Yeah.
Topic that is
How you doing, Michael?
a fun topic. So, Michael, let's talk disability insurance, my friend.
Of
Ready
course.
to go?
Yeah, thanks for having me, guys. I'm really looking forward to it and hoping to shed some light, provide a little information and education. Definitely looking forward to it.
Awesome.
So one of the questions that we wanted to ask you is, because we really want to offload a lot of the replies that I get from doctors when I say, you all need to get disability insurance. And they come back and they're like, it is expensive and we don't want to add just another expense. And particularly physicians who are in training, you know, they're making like $3,500, $4,000 a month in take home pay. And I'm trying to convince them to spend $175 a month on disability insurance. Not saying that they all have to do that, but I'm always trying to advocate for it. Why? In a concise way as possible, could you say, like, why does every physician need disability insurance?
So there's a couple of things. Well, first, I'll take a step back. And while I appreciate the context that most physicians do need it, I agree with that. There's always the random situation where, you know, maybe somebody has, I don't know, a nice trust that is loaded and ready to go. And they really don't have to worry about too much because if something, God forbid, happens, they've got a backup plan, right? So I like to try to explain disability insurance in the context of financial planning because that's really what it is. It's not just you need to buy insurance because somebody told you needed it or because, you know, it's the law and you have to have it. You know, car insurance, you can't drive a vehicle without it, right? Or not legally, at least. Homeowners insurance, no bank will let you buy a house and, you know, that they're giving you a mortgage for if you don't have homeowners insurance. But disability insurance is sort of a self-fulfilling thing, right? You have to have that discipline to say, okay, this is important because my income is important and I don't really have a backup plan. Like there is no other plan, right? Because that's really what we're trying to resolve is, well, what happens if this occurs to you? What if you do become too sick and too injured to work? You know, the odds are in our favor. Chances are you're not going to become disabled and you're not going to have that problem. But if you do, what happens? What's the solution? Because it's devastating to a financial plan and to someone's financial future. And so that's really where it comes in is for physicians, it's a really unique career track. Well, I mean, somewhat unique, right? I mean, entrepreneurs sort of similar. They might make $0 or very little money initially until their business gets going. And then all of a sudden they finally reap a financial reward. Well, physicians aren't too different from that. You're working way more than what you're getting paid for. That's for sure. I mean, the first 4 years med school, you're not even getting paid at all. And so you continue to invest this time into this career path with no real financial reward. And that sounds terrible because, you know, even a residence stipend or a fellow stipend is probably above the average U.S. household income. It's not really what you're doing this for, right? I mean, you're not expecting to make $60,000, $70,000 a year the rest of your career. And so what disability insurance is allowing us to do is protect a little bit of that work and that investment that you are putting into this future career path. Just because you're a resident and you're earning that lower income, if you become disabled, it doesn't mean that you're not going to need a solution, right? You can't just make $2,000, $3,000 a month for the rest of your career. I mean, certainly after putting in 5, 6, 7 years of time, that's not really a great return on your investment. So I think disability insurance is really there to fill that gap. And from a financial planning perspective, answer the question of what happens if you do become disabled And for physicians specifically, it's unique because they're investing so much time up front without getting that financial reward. They're not making a lot of money early on. It's all for delayed gratification. And if something happens during that 6, 7 year, 10-year commitment, it all kind of went down the drain. I think having something is better than even nothing, right? So you're right, Tyler. And I think every physician who would say this is right. It's expensive. It really is. We don't become immune to this. We're not naive. It is expensive, particularly on a residence stipend. And it's particularly expensive for a couple of reasons. So the normal residence stipend is, ballpark $60,000, $70,000, right? Maybe a little bit below, maybe a little bit above, depending on where you are. But the amount of disability insurance that the insurance companies are willing to offer you is disproportionately high for that income. So I'll give you the 30-second version of this. Normally, when you're buying disability insurance, the amount of coverage you can buy is based on your income. And for residents, the typical amount offered is a $5,000 monthly benefit. Well, normally to get that, your income has to be $100,000 a year. So the premiums for that would be a little bit easier to handle if you are making $30,000 or $40,000 more per year, but you're not. You're only making 60 or 70. Now, this is really nice because it's allowing you to ensure a bit of your future earnings potential, right? It's not making a huge dent if you're expecting to make $350,000, $400,000 a year, but it's at least better than just what your GME provides through a group setting. And so anyway, having the 5,000 is really nice because it's more adequately protecting you, but it is also disproportionately expensive because the premium for that would normally be being paid by somebody who's making more money than you are. So if it's a cost issue that's really holding you back or making it very difficult, start with a lower amount. Anything is better than nothing because this problem is there. And if there's nothing at all, then the problem is really big and there's no solution to it. But at least having some coverage would start providing some resolution to that problem or that question of what happens if you become disabled. But yeah, that's how I like to look at it. I don't think it's just because people tell you that you're supposed to do it, or it makes somewhat logical sense from a financial planning perspective, right? Looking at it holistically.
Can tell you, you've got all these things like right on the tip of your tongue. Like I just go back to the fact that there are just a couple of things in a physician's life that can massively hurt their financial prospects, and a loss of income is probably number one.
Oh yeah. And it's hard to imagine it happening when we're young, right? But when you've been doing this long enough and you do see those claims come in, right? You get somebody who's a year out of training, 2 years out of training, really serious cancer diagnosis or whatever it might be, a car accident. I mean, there's a lot of examples. And all of a sudden that person reaches out and you go, holy moly, it's like actually happened. This person's so young. I mean, they just finished up their training. It's kind of devastating. It's not even our financial situation, right? But we sort of feel this obligation to hope that we did the right thing. We got the right amount of coverage. We got as much as we could get, to get that paid as quickly as possible. It's tough. I mean, it is really serious. It doesn't happen to most people. I think we all know that. This isn't about it being in your advantage that you're actually going to use it. It's just about what happens if it does. And you want to have that protection for sure. But some people have a backup plan. If you got to trust, if you have a spouse that, there's all sorts of backups that could be there. If you don't, insurance is the backup.
As you're saying that, I just thought this would be a good question to ask. If you are a physician sitting there and the premium does feel like too much, Michael, how do you look at it in terms of, I was thinking two different options, but you said, what would you suggest or think through first if you said take a lower amount versus a graded premium?
So graded premium is actually, it's really interesting. For somebody who is like 27, 28, I'm not going to go through too many specific numbers just because the circumstances could change. But somebody who's pretty young, graded premium can look really attractive right now. There's been years in the past where it didn't look as good. 20 years ago, it looked phenomenal, almost to the point where why would you buy a level premium? You would just go with graded. And we've kind of seen that turn a little bit now where I'm definitely having a lot of conversations where after running the numbers, starting with graded for a year or 2 or 3 years, just to get through residency and then switching over to level. Because that's the nice thing about graded is you could start with graded, but then switch to a level premium, right? Going graded the entire way, unless you're expecting to become financially independent and legitimately want to drop this in your early 40s, there's not that much benefit to it. If you're planning on going to 50, great. So you're hitting the break-even point. Well, that gamble could go really wrong. It could go right, but it could also go really wrong. I think the strategy is starting with graded, and then converting over to level as quickly as you can. And so oddly enough, we've seen, again, primarily in that age group, 27 to like 31, 32, where the break even is like 17, 18 years out. So meaning the amount of money you save up front by starting with a graded premium is so significant, and the higher cost of the level premium 2 or 3 years later is really not that much greater, to where by the time that you account for the upfront savings and the additional cost each year, it'll take 15, 16, 17, 20 years before the additional cost finally eats away all that upfront savings. When you look that far out, you're going, well, gosh, in 20 years, money is way less significant. I'm making a lot more of it, that's for sure. Inflation, nobody can forecast the future, but gosh, if it keeps up at a similar pace, not to the last 2 years, that's a little astronomical, but even 3%, the value of that dollar is not going to be as significant. There's a lot of arguments to say, yeah, if you're already looking at a company where graded is offered, right? That's the one downside, is not every company offers graded. But if you're already looking at a company that offers it, I have found myself recommending it more than ever before. It looks, a lot of the illustrations that I'm seeing look really good and almost better, to be quite honest, from a value perspective, or I guess value.
Michael?
Yep.
Just for the sake of our listeners, and you can test me out here, I just wanted to simply explain the difference between graded and level.
Oh, yeah.
And let's you can quiz me I mean, if I'm wrong, or correct me. So level premium is where the insurance company, they establish the average premium that they're going to charge you per year or per quarter, whatever it is, over the life of the policy, which presumably we're talking about to age 65. It averages out the risk level that a given person at a given age is at in the eyes of the insurance company. And then they average all those numbers out and they pick a number that will be constant throughout that term. Whereas graded identifies the risk on a yearly basis. So a younger person is at much lower risk, an older person is at a much higher risk. And so graded is somewhat cheaper than the level premium for someone in their late 20s or early 30s, but then it will gradually outpace the cost and become way more expensive than the level premium if it passes that break-even point that you mentioned of 17 years. Is that an accurate assessment?
Everything was right up until the very last part. So the graded premium, I know, only because you the way you explained it, it kind of makes you think like, okay, well, I'll just keep graded for the next 15 years and then switch over to level where that break-even point occurs. But that's not actually what happens. So the graded premium continues to get more and more expensive. Now, the longer you delay switching to a level premium, the higher that level premium is that you're going to lock into, because the level premium is determined based on your actual age or your attained age at that time, right? So 27-year-old buys a policy on a graded premium, converts over to level at 30 years old, that's going to be one rate. But if they were to wait until they're 40 to convert over to level, that's going to be a much higher rate. And so now all of a sudden, the additional cost is going to be much more significant. I guess the easiest way I could explain that is the soonest you can get to level, the lower the all-in cost will be over the life of the policy.
It's like they're chasing each other.
They're chasing each other, absolutely. But because the conversion from graded to level is going to be based on your attained age, the sooner the better in converting over to that level premium. Yeah. But everything you said was right on point. Graded is based on the risk of insuring someone your actual age. So at 27, gosh, you're a lot less of a risk than somebody who's 63. It's going to be a lot less expensive. But as you get closer to 63, 64, gosh, it does really get a lot more expensive. For anybody who's seen, a quote or a proposal, when you look at those charts, it'll be double to triple the cost by the time that you're in your mid 50s and late 50s. So yeah, without a doubt. But up front, right, that decision is basically, okay, do I pay less now when money is more important to me because I have less of it, knowing that, yes, I'm going to pay more later, but it's going to be at a period of my career where it's not as important. The extra $200 might be worth it to save, I don't know, 800, 1,000, 1,200 upfront in year one and year two and year three. That's kind of the concept. I think the thing that I like most about graded isn't necessarily that numbers part, right? That's kind of the nerdy part of like, wow, this actually looks like a pretty good deal. But like, it's really coming down to the need for this, right? So the whole premise of this isn't, hey, you could save money or you can make this a little cheaper if you do this. It's, you need this disability insurance to protect the investment you're making in your career. So the best thing that I could do for you is get you the most amount of coverage possible. Because although we don't think this is going to happen, if it does happen, I want you to have as much as possible. That's what you're going to need. That's what you're going to want. this is arguably the worst day of your life. You something just happened, and next thing you know, you're not going to be able to earn an income. And so I think that's really what graded provides, is the affordability to maintain that largest amount of coverage. That's really where I think the value is in graded. It's not just reducing the cost, it's sort of leveraging that lower cost for the higher benefit. That's, I think, really where the value is.
I got a pro tip I don't want to forget about. So if any of you are interviewing or working with disability insurance agents and they give you quotes, you need to identify if they're giving you a graded premium quote or a level premium quote when you're comparing it. Because sometimes, correct, I think this is accurate, at least I've seen it, Michael, is that sometimes agents will purportedly say like, well, we've got a really great deal here for you, because we've got like a special arrangement with the insurance company. And what they're really doing is they're just giving you a graded premium just to try to sell you on thinking that they're selling you something cheaper. When in reality, like any agent who works with these companies could offer that to you. So it's lying is what it is. So just be mindful.
Yeah. And which is a shame, because the concept is not bad, right? We just talked about some of the ways in which it actually makes sense. It just needs to be transparent. That's all. As long as it's discussed and everybody knows what they're getting into. But unfortunately, you're right, Tyler. Sometimes they don't, and there are some companies I think are a little bit more notorious for that than others, or certain agents that are a little bit more notorious for that than others. But it's a shame, really, because that person in most situations doesn't actually know that this is the case and that this is what they bought. So yeah, transparency is everything. If they're not being transparent, that's certainly a red flag.
In my head the entire time, I'm just saying, Tyler, no, Tyler, don't. But two fun things to add on there.
Sure.
The reason why I love that topic is because the amount of 5-10 year attending physicians that join us and we're like, hey, great disability policy, but you're still in a graded premium. We're like, what the heck's a graded premium? And we're like, that's our concern there. And we'll, like, when we do presentations, we'll always joke with our fellows and residents saying like, hey, put a Google Calendar reminder on there. The day you become an attending, contact the agent and make it level. This is one you can't just kind of fall asleep at the wheel with, unless, again, some of those unique circumstances that you noted, Michael. But for most of us, once the big kid paycheck starts, switch that over to level, and you should be in a good spot going forward. But I'm glad I asked that question, because I think that was a really good conversation there.
Yeah. It's an important topic. We're having that conversation pretty often right now.
Yeah. I like it.
What about group coverage? Because I don't know a residency or fellowship program that doesn't offer some kind of group coverage. I'm sure they're out there, but most people are going to have access to that through their employer. Is there ever a scenario in which group coverage is enough?
Well, it depends on a couple of things. So you're right. Most GME programs do offer group benefits, right? That resident or fellow is going to have some type of basic disability insurance through their residency and fellowship. Those programs cover or will provide a percentage income replacement based on that resident and fellow stipend. So we talked a little bit about the fact that the physician career path sort of has this delayed gratification in terms of income. You're working, you're busting your tail, you're working a ton of hours, really not getting a ton of pay for it. So this is replacing a portion of that lower income that is really an underpayment of your services. You're worth way more than what you're getting paid as a resident and a fellow, right? And so the group disability is doing something, but the question becomes, is it enough, right? So a lot of times people will say, oh, well, I have something through work. Okay, great. It's covering 60% of your $60,000 salary. That's $3,000 a month. And that benefit likely is going to be a taxable benefit because your employer is paying the premiums for it and taking a deduction for it. So how do you really feel about getting $2,500 a month or $2,200 a month for the rest of your career or your working years if something like this happens, right? So I think from a resident and fellows perspective, is it enough? Not in my opinion, because maybe my bias is slanted in the wrong direction, but I don't think $2,200 a month is enough. So having a secondary policy, an individual policy, is helpful because the two are additive, or at least that's one way to describe it, right? Group coverage pays separately from individual coverage. They do not offset with one another. And what you have through the private policy is going to pay on top of anything that you get from the group. So we're not even going into the definitions of disability with group coverage. As a general statement, I think it is fair to say group plans are generally inferior to privately owned policies. The definitions of disability are not as great. All of the provisions are really just generally not as great. They're more restrictive, less likely to pay. That's part of the reason why they're cheaper. So in that area of a physician's career, I think, no, it's not enough. But it's odd that you say that the way that you did, because there are some situations where honestly the insurance company kind of makes the decision for you. So there is this basic theory that the insurance companies don't want to overinsure you. If you are overinsured, you're making just as much money or more money on the couch disabled. You're not really that motivated to get better and back to work, which obviously goes against their interest. They want you to have some motivation to get better and back to work quickly. And so anyway, the amount of coverage that you can get as an attending is going to be determined based on two things, primarily your income and then any group disability insurance that you're provided through your employer. And there are some employers out there that offer massive amounts of group disability insurance. They design it so that the benefit is tax-free if ever you need it. And because of that, the amount that you can get independently is really highly restricted. I mean, you could be making $600,000 a year. Normally, you'd be able to buy a $20,000 monthly benefit or somewhere thereabout on your private policy. And yet, because of the way that employer has established that plan, you're limited to like $4,000 a month, $3,000 a month. Those individuals are like, what do you mean I can only buy $3,000 or $4,000? I'm making all this money. How can I only buy this amount? And it's because that group plan is set up that way. So, and even in that situation, is it enough? Well, I mean, the specific organization I'm thinking of, which is a massive hospital system in Florida, the group plan that they have is actually a really crummy group plan in terms of the quality. I mean, the definition of disability is awful. But it's just a massive amount of coverage and you can't get away from it. They're paying for it. You cannot opt out of it. And it's kind of to the physician's detriment, to be honest, that they can't get better quality individual coverage because of that. But that's a situation where the decision's made for you. Do you have enough? I would argue maybe just not enough of the right quality, but the insurance company would say, yeah, you have enough. We can't sell you much more.
I think I'd even potentially at least consider like reworking the contract as a subcontractor to get out of that. I mean, there's a lot of other factors to consider.
Tons of factors. Yeah.
But that I've come across something like that a couple of times, and that's very frustrating. So
it definitely can be. And then finally, I guess the last example I would give is just somebody who, from a financial planning perspective, doesn't actually need the insurance, right? I mean, that is the root of why someone needs this. It's not just because we told them they did. It's because their financial circumstances dictate that they do. They don't have any other backup plan. But I mean, if you're a pediatrician making $140,000 and you're married to, I won't say any specific specialists, but higher paid specialists who are making seven figures, does the pediatrician, need coverage? Maybe a little bit. Do they need a lot of it? Probably not, right? So if there's a family trust with insert whatever amount of money you think is enough, in there, then do you need it? Probably not. There is a point at which there's enough, but I think that should be governed based on need, right? What is the financial planning circumstances? What does their overall financial picture look like? And that really should be what determines that, I think.
Building on that one, another follow-up question. How often, if possible, in more or less general terms, let's go back to that group conversation on it's a crummy group policy and it's eating up pretty much your insurability amount, so you can't get much private. For plans that allow you to opt out or not take that coverage, I feel like this is one that's not discussed enough. I think for Tyler and I, because we're in the weeds, it's a conversation we can have more often, but I think the general context for most physicians, they're not even thinking through that. But how often should a physician even be thinking through, maybe this is one that I opt out of? If you had to say, these are the two things I'd keep in mind, what would you say there, Michael?
The definition of total disability is probably one of the most important provisions in these policies, right? So the best of the best out there is what's called a true own occupation definition. And it says that you're considered disabled if an injury or sickness prevents you from performing the material and substantial duties of your occupation. And it'll stay that way all the way until age 65, meaning that is the criteria the insurance company is using to determine if you're disabled, right? It's going to consistently be based on your material and substantial duties. That sounds pretty good, right? But there are group plans that will use that type of definition for 12 months or 24 months. And then after that, it'll say something like you're considered disabled if an injury or sickness prevents you from performing any occupation you can reasonably be expected to do based on your education and training. Well, physicians are pretty intelligent individuals and hard workers. And so that's pretty vague definition there. That's not one that I would necessarily want personally. let alone if I was a surgeon or, had gone through 7-10 years of training to become what I am. So I think that that's the issue, is the definition of disability. That's the tipping point where perhaps that person will say, yeah, that's just too crummy of a policy. I don't want it. I'd rather opt out of it. This is a really difficult discussion, though, because at the end of the day, this is a gamble, right? That's what this is. We're paying money to have the protection, hoping that we're never going to need it, but taking the gamble that it's worth paying the money just in case we do need it. That's it. It's a gamble. So us three do not know what the answer to that question is. I think generally I try to leave it up to the client, saying, look, here's what you're deciding between, right? This is the situation with this plan. This is the situation with this plan. If it's that concerning to you, great, opt out of it and get your own private coverage, and that's it. Call it a day. If you ever become disabled, that will probably have been the better decision, unless it's a really, really terrible disability where you're just totally disabled across the board and you can't do anything. Because there is an instance, again, kind of getting into the weeds here, there's an instance where combining group and individual actually allows you to get a larger amount of total coverage. So if you do happen to become disabled in a really significant way and you do qualify for both, then the total amount of income protection you might be getting, could be higher than if you were to opt out of the group and just elect individual coverage. So, man, that's a tough question, and there are positives and negatives to both. And I think the key is for people to understand that those positives and negatives and then make their own decision, because it is a gamble, and, they're the ones that have to live with the decision. That's not an easy one. I think a lot of agents would say, oh, get rid of the group coverage and just go individual, and there is an advantage to that, but there is also an advantage to go the other way.
Yeah, I think most don't even understand the difference. And that's why, again, another great conversation to have. Like, we're so used to hearing like true ONOC. And I think a lot of physicians assume like, oh, that's what all policies must be, because that's what we hear. It's pounded to us. Where in reality, that's the only reason why we look at only 5 providers. The rest are actually that modified ONOC or, heaven forbid, an ANIOC. And I think just even making that aware to physicians to understand, these are just like those little tidbits that I think can go a long way. So I know there's not a perfect answer there, but that was well said. And I think it helps kind of justify like yay or nay, and then family situations, trust funds, all that. It's all going to play into it. But at least knowing that is important.
Yes, I think the information, the education is the most important part, right? Understanding the options and truly understanding what's at stake. Yep, for sure.
Yeah.
Also, anyone who's evaluating options, you'll come across language that is written to be more compelling to physicians. There's even some companies out there that will have a type of policy known as a medical occupation policy. And that is somewhere in between any occupation policy and a true own occupation policy. So it adds to the confusion.
Yeah, ask for clear explanations. The concept is you're disabled if you cannot work in your occupation. It's irrelevant whether you're working in a different occupation, whether you're earning an income in a different occupation. None of that should matter. Once they start intermingling the two, you're no longer dealing with a true own occupation definition.
When are they going to come up with a financial occupation policy, Michael? I'm just kidding. No, when you hear that, when you see that like medical occupation policy, that is an appeal to be like, oh, well, this is for you. But that doesn't necessarily mean that it is for you.
Right.
And that's all I've got to say about that.
We're going to have a cease and desist at Tyler's house within the next 3 weeks when this goes live. So as soon as you said the wording, I said, I know where we're going.
Yeah. Nope. Just gotta everyone. You just gotta make sure. Just ask tons of questions.
Ask questions.
Ask lots of questions.
Yes, that is a good tip. Ask questions.
I love it.
So, Michael, one question that I really wanted to ask you, because people will tell me, they'll say like, well, like, have you ever seen like where this is even like when it's actually been useful? Because I don't know of anybody that's ever actually had a claim. And of course, our own personal experiences are never going to be representative of everybody else's. But, anecdotes have a degree of benefit, even if they're not necessarily evidence of making a decision. But you probably have seen a lot more than either Chad or I or many other people. Do you have a personal story that you could share? Of course, we don't want to keep it anonymous. But
sure.
Is there a story that you can think of that demonstrates the power of getting disability insurance the right way?
So I guess that comes in multiple contexts, right? The power meaning the financial backing that comes from it, and saving someone financially. There's also the examples of like situations where it actually happens, right? Because again, none of us think this is ever going to happen to us, and yet it does. I would say, without going into specific examples, I would say cancer is one that has really kind of hit home for us. I think that cancer is the number one contributor to earlier onset claims that we've personally seen. That doesn't mean that that's the statistical likeliness to happen. It's just what we've experienced. And honestly, I've experienced it most with young physicians, like 2-3 years out of training. It hits differently when it's somebody that young and just got out, just started making some real money, hasn't really put much aside, probably at a stage in life where they're starting a family or maybe has a young family. It really hits home a lot. So I won't go into too many specifics, but I will definitely say that just this year, we've had two earlier like career young physicians who were both diagnosed with pretty aggressive cancers. And thankfully, at least on one so far, the treatment went very well. But then there's lingering side effects that you don't expect, right? So surgery went great, chemo went great, radiation, all the treatments went great. But then there are side effects from those treatments. So like neuropathy that wasn't expected, and that neuropathy isn't going away quite as fast as was expected. And so what was maybe only going to be a 9-month claim or a 12-month claim is now like, we'll see. We have no idea where that's going. And I think it just sort of substantiates that like this is important. Cancer is, I think, the one example that none of us feel like we're invincible from, right? You can't get hurt rock climbing if you don't rock climb. But cancer, there's you could eat healthy all you want, and maybe that changes it. Who knows? But we all know that we're all equally capable of having that type of news. But we've even had things like people getting injured, so random accidents. Someone who was carrying an exercise bike up a set of staircases and fell by accident, and it was not pretty. Like full out traumatic brain injury. Didn't think he was going to live. Ended up living. Will never operate again. Clearly. And gosh, how many times, not to be like chauvinistic or anything, but like how many times have I been like, yeah, I could carry this up the stairs, no problem, and I carry something heavier than I probably should without asking for help. And gosh, it can happen to any of us. And it's one of those things where you go, wow, that was a sole earner for that household. This would have been devastating. And the spouse didn't have that same higher earning potential. With 3 kids, I mean, that's just so I don't know that I can give you an example where I was like, wow, that check was so important and this is what it did. And they were able to pay, they were about to be homeless and they, all of a sudden they were able to pay their mortgage payment. It's more so just the overall circumstance. Like this guy was healthy, had all the positive stuff coming his way in the future, and next thing you know, such a simple task that is just normal. We all do little things like that. I mean, he wasn't carrying 500 pounds. He was carrying, an 80-pound exercise bike, not that big of a deal. And that was it. So I think it's more so just eye-opening when you see these examples and you go, wow, that could happen to anybody, or the cancer stuff. Wow, I know people in my family or in my close, social network that have had that happen at an earlier age. Car accidents, gosh, driving is probably one of the most dangerous things we all do. We've definitely had a fair share of claims from car accidents. Oddly enough, some where the accident happens, person, recovers, feels fine. All of a sudden, 6 months later, their dominant arm, has neuropathy in it or some type of symptoms, numbness, tingliness, whatever. It's not so great for a proceduralist. So, yeah, I mean, we've seen a variety of things. I will say I've been doing this for almost 20 years now. Probably for the first 10, it's very limited how many claims we saw. And I feel like that has now accelerated tremendously over the last 10 years, over the second 10 years, to where there is no doubt. If I talk to whatever the number is, 500 physicians a year, 1,000 physicians a year, somebody is going to become disabled. Like statistically, it's just going to happen, right? One of those individuals is going to become disabled. I have no idea who it is. And that partially has an emphasis on that bias or that philosophy that my goal is to get you as much coverage as we can get you so that you would get that money as quickly as possible. Because I don't know if it's going to be you or if it's going to be your friend or if it's not going to be you, but we want to have that protection. Yeah, it definitely hits home when you start seeing claims actually happen.
That physician in the exercise bike accident. So, I mean, obviously, life continues and there's things that happen, but from what you can tell, they really benefited from being covered.
It's the only income source he has right now. It's it. If it wasn't for that, there would be no money in that household.
Yeah. I remember that being a strong motivator for me years back when I got my own coverage. My wife actually mentioned that to me about it would just be life-changing to suddenly not be able to, earn an income. So yeah, I appreciate you sharing that. There's a lot of minutia here. We could have even talked about more, and we'll probably have you on some other time in the future to dig in further. But everyone who's listening or watching today, we want you to take what you learned today and recognize that getting disability insurance that is appropriate for your situation within your reasonable ability to pay for it, whether you're in training now or out of training, you need to take this decision process really, really seriously. If there's one thing to learn from today, and you haven't addressed it yet, you got to do it as soon as possible.
I think what you just said is really well spoken, that you want to give this thought, right? So this is one of those things that sometimes physicians might be like, I just need to get it out of the way. I just want to get it done. But the reality is this is awfully expensive coverage. We've talked a lot about the cost. It is expensive. And normally when you're buying something that's expensive, you do your due diligence, perhaps, and learn a little bit. So don't necessarily just rush in. Try to find someone who does know what they're talking about. Get as much information as you can. I think that that's really the biggest advice. Not just, if you're working with somebody who's supposedly an expert, they're going to give you great, advice. Maybe they have an off day, who knows, right? But try to get as much as you can get so that you can make your own informed decision. You're the one who has to live with the decision at the end of the day. It's only fair that you know all of the consequences of that decision to make sure you're making the right one. But give it some thought. It is important. Even for younger residents, it might seem unaffordable, and I totally get that. It's not easy. But the idea of it and the reason you would get it, I think, is somewhat logical and does make sense. So at least learning and exploring it, I think, is a good thing.
Well, thanks a lot for joining us, Michael. We appreciate you sharing your expertise with us
It was
and
fun.
everyone who's listening. And we'll chat again soon. And
sounds great.
Any closing thoughts, Chad? Or are you ready to just get out of here?
No, I love it. No, I could keep talking exact opposite. I was like, can we just set a record for our longest episode? We can just keep going. No, thank you, Michael. It's just one of those topics. I was just thinking, I feel like we're somewhat spoiled too, in the sense of physicians that are reaching out to us. They obviously heard how important it is somewhere, but the amount of physicians that don't know that yet, that's where it's like, the more we can get this word out there that, hey, just kick the tires. This is why it's important.
Yep.
Do your research. I mean, honestly, when Tyler reached out and said, hey, let's do a podcast, that was my big thing. Like that one, Tyler has a decent Twitter following, like 100, 200 people maybe. But, getting that word out there to a lot of people, that was my big appeal with this podcast. And having experts like yourself on here and part of our platform and just, being there as a resource, this is fantastic. So, no, I don't want to get out of here. I want to talk for hours longer, but we're going to cut it here. But, we're definitely going to be talking to you a lot as we move forward with this community that we're building here. So I appreciate it, Mike. Thank you.
Yeah, of course. I'm excited and look forward to chatting again.
Thanks, Michael.
Take care, guys.
You too. See ya.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.